Well, first of all, I would like to thank you for your time and for accepting to be with us on this podcast.
Thank you.
Quick presentation to everyone who's listening. Today we have on the show the most copied popular investor on eToro with over 20,000 copiers. You probably have more copiers now and 500,000 followers and over $70 million in assets under management. Mr. Jeppe Kirk Bonde, pronouncing it as a Swede. Correct me if I'm wrong. Before I start, is there anything you would like to add on this presentation? Like, how would you present yourself?
I think that's a good presentation. To those that don't know eToro, I can just quickly say that it's an investment platform. So you can download the app or use the website, and then you can invest in stocks or cryptocurrencies, commodities, and all the various assets that people use. And yeah, I've been using it since 2013.
All right. And how did you end up working on this? I remember when we met, the first time was at university. You were studying international business and politics. So basically you were interested in both. What made you shift to pure investment? Or is there a link between politics and investment?
I think there is. Certainly when I started at university for political science, I was most interested in politics. And as some people might know, my father, he was a member of the European Parliament for 29 years. My mom was the founder of an EU newspaper. So I was sort of born into a very political household. And so I always just thought, I'd go the same way of my dad and go into politics. But then as the years progressed at university, I sort of thought that the politicians don't make much of a difference. They are, fighting very hard that taxes should be 1% lower, 1% higher. And I was like, am I gonna be caught up in this pointless discussion over, not really doing something that's objectively better than the other thing? And then I found management consulting to be sort of where the action was, where they got all the interesting projects. So at the end of the day, a company or a large institution or political organization has something important they need done. They hire some consultants to get it done. So then I figured, okay, I'm gonna be a management consultant. Then I switched for my master's, I did finance, and then I started afterwards working as a management consultant. And then as a management consultant, one of my core piece of work became valuation of companies. So calculating how much is a company really worth based on their financial statements, their assets, their strategic opportunities, how they are in comparison to their competitors, and so forth. And then as I was doing that, I also was making money, of course. And then I wanted to invest my money. So I started investing on eToro. And then as that kept going very well, eToro had this feature where if you don't know what you want to invest in, you can just copy other users. So then many people, they started copying me on eToro. And then more and more people were copying me. And then while my consulting career progressed, I moved from Denmark to London and started focusing more on technology and banking clients as a management consultant. But then eventually sort of eToro just took over. I was making a lot more money from my investments than I was from my consulting work. And then in 2017, I just thought to myself, okay, I need to just focus 100% on this, because otherwise, 10 years later, I'm going to always wonder what would have happened if I gave this everything. And then since then, it's just, gone even better. And then, then in 2021, towards the end there, I finally overtook Jay Smith to become number one. So that was a very, very happy day, because that was been my goal for a long, long time.
Did you celebrate it?
Well, to be honest, when I first hit like $10 million in the asset under management, I bought like a nice bottle of champagne, if I recall correctly, and same at 20. But then sort of as the things to celebrate have gone on, it's become less and less and less. So I think I just celebrated by going for a swim and having a nice dinner or something like that. It wasn't some also with a COVID sensibility.
Oh yeah, exactly. Which must have also impacted the amount of investments. Do you think? Can you tell us? But before we talk about this, I would like you just to unpack for anybody who would like, because we hear a lot about investments, about the stock market. Can you just simplify it if you were to explain the concept to somebody who has money but who does not know how it works? Because usually we hear people saying, if you don't know how stock market works, you better not even get there.
How does it work? And that's wrong. There are different levels at which you could consider someone a successful stock market investor. So if someone, you know, historically, since the very first equities have been created, but also over the last 200 and 100 years, stocks have provided the highest return of any asset class. It's been in real terms in all that period 7% per year. That's effectively doubling your money every 10 years. So stock has been a very good
That's
asset
more
class.
than we can get from the bank, right?
Much more. So to get historically, I've gotten 7% on stocks. Maybe you've gotten 4 or 5% on property, slightly less on bonds. But if you hold cash, for instance, you might lose 2 or 3% per year on inflation. Now the future can be a little bit different. All of those numbers are a little bit lower now. You're getting less for bonds, inflation slightly higher. Stocks might also, rather than giving you 7% based on the current profitability and earnings forecast, you might only be getting 4 or 5% real return. But that still means the stocks are still better than the others that are then better than the others. But fundamentally, if you had back then just picked a lot of stocks, randomly, and not touch them, you would have gotten that 7% over that long period of time, and that would be a successful investor. Now, of course, someone who spends all of their time working in an institution or something to try to gain a slightly higher return, that might be able to do so. Maybe they can then get from 7% to 8%, or maybe they can, if they really have an insight on something, in the same way as someone who makes a startup work or changes an industry or something like that. If you can really add some insight in some way, maybe you can have a lot higher return. But that's not really required. It's already a very good case you get at the baseline. The idea that you can buy lots of effectively random stocks, or with a, if you had a little bit more smart, sort of trying to actively get diversification. Randomness does actually give you some diversification. If you just add enough, it sort of ends up. But if you only invest in one ETF that has all the American stocks, that might be less diversified than if you just pick randomly. So with that, it means that stocks effectively is an asset class that's relevant for a lot more people than are investing in it. And also, the reason why stocks have historically paid a high return on investment, and the reason why if you buy a property and then you rent it out, you might make some excess money, is that not enough people are doing this. There are many people who want to spend the money right now, who want to just pay the rent and not have to deal with getting a loan from the bank, or they don't want to have a property and improve on it and decide on whether to change the windows and all this. And because of that, the fewer people who want to be on one side of the market compared to the other, the higher that return on capital is. Effectively, maybe one day we'll have a world where there is completely sufficient capital for everybody, and the return on capital won't be that high. But that only comes if people actually create capital. If people go out there and say, I'm going to make my house better. If people say, other people build a new house, or people say, rather than spend my money on a product that's then used, I'm going to instead invest it, and then that money is used to build more stuff, more farms, more factories, more capital. And then effectively, when you do that, you drive down the cost of capital. But when the cost of capital is already high, you're gaining that return. And during COVID, most people sort of that have, especially people that have some cash in their account, or too much now at negative interest rates, sort of understand that I should have been buying some stocks. I should, find time to buy some stocks. I'll do it in the weekend, but then the weekend comes and they don't get it done. And it's sort of, it's the same with everything financial, basically. People's pension, their insurance, their, even, like maybe you're paying too much for your phone bill or something like that. All of these things have been things that people have finally gotten done during COVID. Because a lot of people, they were home and then they were like, oh, I got to use my time for something useful. What can I do? And they realized, oh, I have all this cash that's not doing anything for me. Let me finally open that investment account and start investing. Or let me actually look, what my pension fund is, how much am I actually paying for that? How much is it actually giving me? And sorting these things out. And then, you might not feel that difference over 1 year, but if you look at two people that work the same amount in their lives in the same industry, but when they retire, because one of them was sort of financially savvy and just did the standard good stuff along the way, he's amassed quite a fortune for his children, and the other hasn't. And that's sort of it's certainly putting your money into stocks is risky in the short term. You have in any 1 year, it might double, it might halve, you really don't know. But over 30 years, that risk is a lot less. It's the same thing if you flip one coin, is better if you roll one die, you don't know whether it's going to be 1, 2, 3, 4, 5, or 6. It's very risky. But if you roll 30 dice, you can be quite sure that the final average is going to be somewhere between 3 and 4. And that's sort of more the so if you sort of of course, everything can change. Maybe people won't want to work in companies in the future, or suddenly, today we live in a world where it's governments and companies. Maybe one day, it could as well have been guilds and religious orders or something. There's big things can happen. But if the history has been a guide, historically, it's been very good to own companies, and it's been very good to be a shareholder in companies. It's been very good to found companies. I think that's also the case now. And so people that have a lot of excess cash should probably at least consider, it effectively, property and stocks are both good investments. I often tell young people, when you're completely young, that education is the best investment you can make at this stage. After education, it's sending out your CV, then it's probably buying a property, and then it's getting stocks. Then nowadays, lots of people are very interested in the alternative asset classes, so such as crypto and wine and all of that stuff. And sort of individually, for various periods of time, there have been some good ones. But tulips back whenever the tulip bubble was obviously not a good one. You add up all of those different sort of collecting stamps. I think my dad, he collected stamps, right? They all had a high value at some point, and it all went down again. So if you sort of look at all of those things where you really those on average have not yielded a positive return, so they're not really something that is, you can pick the right one, you can be lucky in that way, but it's not something that in sort of a conservative portfolio you need to necessarily have in your portfolio. And if you are going to have it, it's certainly not something that should make up an amount that's really necessary for you. Like if you're trying to if the money doesn't matter to you, you can take more risk. But there can be this stage where you say you at least want to have a certain amount of it put in a nice way, because then that provides some sensible risk capital that actually on average would have given a good result, and on average might give a good result. So you're sort of there are different risks in markets, and some of them you actually on average rewarded for taking. So if you invest in stocks that on average would yield something like 5%, it's like, if you say it's like gambling, but in gambling, whenever you play on the roulette, you lose like 3.5% or something. But in the stocks, the bigger stock, you win on average 5%. So it's a lot better type of, the house is on your side here. The stock owners are the house here. So it's sort of it's a different,
So it's like a myth that, like in the popular culture, people tell you, okay, don't get there. Even I know that the guy who's Robert Kiyosaki, I think his name is, Rich Dad Poor Dad. He usually says, I invest in real estate, but I don't even know how the stock market works. Now you mentioned real estate, stock market. Why do we have to start with the real estate? You said, buy a house and then go to the stock market. Is it just prepares you as a young man to
it depends. So both for stocks and real estate, it's generally necessary to have at least a 5-year horizon. I would probably maybe even say a 7-year horizon, and ideally longer, because obviously there's a lot of getting started costs involved and so forth. There's some, when you buy a house, you might pay a fee to the real estate agent and so forth. So you certainly don't want to be trying to buy and sell and buy and sell and buy and sell, something like that. But in in many countries, the first property you buy, the gains on that have a tax advantage. And also it falls in a very special risk category. Unless you really, really like hiking and sleeping in a tent, it's fair to say that everybody needs one property. So you need at least one property. So you are born with a need for one property. So you basically already have a risk. You are born with this risk in your life. I need a property. But then by buying a property, you eliminate that risk. So now your need for property is, damn it, I have a need for a property, but I also have a property. So effectively, that makes it's an extremely low risk investment, because that you might find it risky on its own, thinking like, the property goes up and down in value. Yes, but so does the price you need to spend on owning a property that you need as well, and those will actually go up and down together. So you get so the first property you buy is in that exceptional risk category, probably tax incentivized, and therefore it can be a very, very good investment. And there are other aspects as well. It's often the cheapest way you can get financing. So if you're just trying to get a loan or a car loan or something like that, it's going to be a lot more expensive than you're getting a mortgage. And then with that leverage, it's effectively cheap leverage, which makes for an extra good investment. Yeah.
So the mindset, like, when you want to invest in the stock market, you should have at least 5 to 7 years of range before? You shouldn't evaluate your losses or gains in the first year, for example.
You can evaluate them every day. That's fine. That's not the
How does
point.
it work?
But you should not. So firstly, it's important to say that investing, ownership of companies is a very profitable enterprise. When you buy a company, now you own a part of the company, and that company grows. Maybe it keeps all the money, but it keeps growing, buying new assets, expanding itself, buying other companies, whatnot, or it might pay out a dividend that you receive. Ownership of companies is great. Investing is great, but trading is on average a loss-making business. And that's where people get it wrong. They think that they need to be traders, buying and selling and buying and selling and predicting what will go up in the short term and down in the short term. And that's what, if looking at the market every day makes you do that, yeah, then you're better off not looking at the market at all and say, these, invest, don't look at it, come back 7-10 years later and then see. But of course, the best is of course to look every day and then not trade, look all the time and then not trade. That's what I do as well. It's a lot of research and very little trading. I like to keep the things that I have because I think they're the best ones, but then things happen and I do need to make changes to the portfolio. But I certainly spend a lot more time looking and researching than I do trying to buy and sell. And that's where people should not think that they have some special insight that they can. And a lot of people, unfortunately, when they go online, they get sucked into all sorts of methodologies like, using technical analysis, you can do day trading, and that's on average and negative returns enterprise. So because of the fees you'll be paying, then after a few years you'll probably have lost money. Whereas buying and holding, that will have on average have gained you money. So it's that sort of so understanding that you can be a successful investor just by being average is good, but you can by being very, very active and thinking that you're smarter than you really are and trying to be paying the fees every day to buy and sell, that'll make you lose money.
Yeah. So the idea as a new investor or somebody who wants to buy stocks, let's take eToro as an example. You get there, you get an account, and then where to go? Do we look at the most at a Tesla or like the biggest companies and try to buy a stock there, or where to go? Where to start really? Like how to choose your first investments?
So
like let's say we have $1,000 to invest as an example. What would you do as an expert with $1,000? You would diversify, obviously, as you said before.
If it has to be in specific assets, then my portfolio on eToro, it's visible, everybody can see it. Those assets ranked by how much I've invested in them or how much it's currently valued is what I think is best to invest in. That's based off of my valuations, what I think the companies are worth, how I see the future, and so forth. But for other people, who don't really have an opinion like that, I would say you can get quite close to home by picking just 30 different stocks from 3 different countries and at least 5 different industries, and then you are effectively buying stocks in an auction system, which means that what you are buying is what the weighted average of all market participants have said it's worth. So on average, if you know nothing else, you have to assume that that's the correct price. Now, it might, of course, not be the correct price. You might have something which is like, but that's because of some trend people are following or whatever. But on average, across the many different stocks, you are getting what the auction is saying is the fair price. And that's, and people say that the market, the market is not efficient. It's not, but it's not inefficient. It's somewhere in between efficient and inefficient, right? If it was completely inefficient, then the best company in the world would cost the same as a new lemonade stand. And if it was completely efficient, then it wouldn't matter which one you pick because all of them were perfectly priced. But if everything was completely inefficient, it would definitely make sense for a few more analysts to spend their time valuing which companies are worthwhile. That lemonade stand is not worth as much as Facebook. I'm gonna sell lemonade stand and buy Facebook. And then then if too many people are analyzing it in a good way and all the prices become fair, then it pays to just say, I'm just going to take the market prices there, no research, and just pick these ones.
Right. Okay. So do you, when you choose when you decide on a profitable, when do you decide to invest in a company, do you look at the founder? Do you look, in addition to the financial statements? I know that sometimes, like in the Silicon Valley, they talk about, angel investors usually they focus more on the founder than on anything else, because if they believe in the founder, then they put the money there. How do you do it as somebody who invests in a stock?
I mean, no doubt that also for very large companies, the CEO is very important, but probably less so than in a completely new small startup where it's, just as a percentage of the pool of employees, the leader takes a smaller role, and you might have a very large company where it reaches the point where there are several people that could, that would take it in the same direction more or less. But I do look a lot at what the CEOs say, what I think about them. Do I agree with this strategy? Are they doing the things that I would want them to do? I take very much the perspective, what would I advise them to do? So if I was a management consultant coming in here, reviewing this company and having to advise the management, what do I need to know to advise them, and then what are then my sort of recommendations for them? And I cover about 150 companies, and I've invested in 63. So I look at their financial statements. I have lots of tools that provide me all the data automatically. Then I add all my own unique insights. How good looking do I think the CEO is? How anything that can be put in and help me rank the companies, and then I rank them for how good investments I think they are. And in that is when I start sort of covering a company, it's a long process of going through all their products, their financial statements, talking to some of their employees, and really just getting a deep dive into what is this company all about, what are really the scenarios that are open for them in the future, what are the risks, if then then that's what gives me my overall valuations. And in the end of the day, it does come down to assessing what's the company really worth and comparing that with how much does it cost. And I want to buy companies that are worth a lot more than they cost. And then all of those companies that I buy have to fit together into a low or medium risk stock portfolio. So on eToro, we have a system where you get measured from 1 to 10. So 10 is the highest risk. I think if you have a risk of 10, you get kicked out of the popular investor program. Then people are not allowed to copy you anymore. And I try to be between 4 and 5. So I can sort of always see if there's if one of my positions, for instance, grew a lot in value, I might, but then I can see there that this is causing my risk score to go up a bit higher. I then have to evaluate, do I want to take this extra risk? And I might say, I think this is such a good investment here that I do want to take this risk. And then my copyists will be taking that same risk, but that's based on the version that I think this risk is worthwhile to take. And other times, like, you know what, actually, I don't want to be raising my risk for this. I'm gonna reduce this position a bit in order to reduce the risk a bit, even though maybe my average return would be slightly higher by taking that extra risk.
Well, on this note, in 2014, you invested in Tesla, I believe, or
2016.
2016, sorry. What made you think, okay, it's worth your, risking your money there?
Yeah, Tesla's been a very interesting stock to have in the portfolio all along. Certainly been the most unpopular. Everybody was telling me since 2016 when I bought it, the total company cost only 5 billion, and then it went over 1 trillion, of course. And but when Tesla was founded as an electrical vehicle company, I had no interest. I've never had any interest in electrical vehicles. I don't think it's an interesting industry. And then when Tesla announced self-driving, I became very interested, because I'm very interested in how robots see and analyze what they see and what this can be used for in the future. So that's why I invested in Tesla. Then Tesla has grown a lot, and a lot of valuations that I see are very focused on, how are they doing in the self-driving car market, and how are they doing in the electrical car market and the electrical vehicles and batteries. But I don't care about any of that stuff. So my Tesla valuation has never, it's based on completely other stuff, basically. I had a very good conversation with the founder of the guy who works at Tesla, who's done the Tesla bot. And that's something that interests me a lot. But sort of all the stuff that's talked about of Tesla has no interest for me, and it's very irrelevant to my valuation, actually. So that's why it's been a sort of very difficult along the way, because people come with a very good explanation for why they won't sell this many electrical vehicles, or why 40 electrical vehicles and I can't really argue with them, because I don't disagree with it. I just find it irrelevant. And also, it's not my job to there's this sort of problem in investments, is that if you want to sound clever, you give away your good ideas. If you give away your good ideas, you'll sound clever, but then you'll be a bad investor. One horrible example of that is
Yeah, exactly.
Ray
Yeah.
Dalio. Don't know if you know him, but he's
Yeah,
the
of
founder
course.
of,
The
yeah.
principles.
So he's done
Yeah.
exactly that. He's given away all his good ideas all along the years. And that's of course made the world smarter. I would say he's led a very successful life, teaching everybody about investments on the markets. But there's one group of people that he's not made happy, and that's of course his own investors, because they have not had good returns in in his investment career. And
Yeah.
probably if he had just kept his good ideas to himself, had not explained how the economic machine works and so forth, and just kept that as the good insights, they would have yielded value for his investors year after year after year after year. So there's sort of
Yeah.
a problem there that the sort of the real good nuggets you sit with there that can yield. I can use that to find a good investment next year. Something else comes up. I can use this little insight. I have to pick up another one. Like those are great, but you can't sort of share them everywhere all the time. Then and yeah, that was the case for me for a long time with Tesla focused on other stuff than others were focused on.
So you wouldn't give away all your good ideas to this podcast
No,
today.
no, sorry.
That's good to know. That's great. I'm actually also interested in knowing how a normal day in such a successful investor's life look like. Like you wake up. Obviously, you can work from anywhere in the world. You can work from home. You can work from any on the beach. Like if we were to look, to use the cliche. Um, what's the first thing you look at? Like you have all these the funds that you're managing and your your own funds as well. Do you look at them? Do you read the news first to get a sense of what's going on? What do you exactly do with that?
So I
How does it
have
work?
this. I made my own project management tool. So I have all of the activities that I ever need to do. That's including like going to the fitness center and I don't know if I need to buy something. Everything, anything that takes more than 5 minutes, I have listed for everything I need to do for the next many years. And all of this, I've assigned points. How valuable is it? Effectively, that's equivalent to how much would I pay to have that thing done immediately.
Yeah.
And then I have, if anything needs to be done before other things, then that value might get to that one. If that one would be my top activity, then I have how long do I expect things will take, then how valuable is it divided by how long it would take is another metric. Then with lots of other stuff, basically if I have different tags for things, so if I think one category is more important, I can just increase the value for that and then reorganizes everything so that I now have the things I need to do. And then that basically just has the order of everything that I need to do, and then I just do things from the top. So I work on try to always work on the thing that's the very most important thing I could be working on, and then when that's done, then
Like
the
time
next one,
management.
then but there are some routines that sort of stick every day. So I usually wake up and then I just grab my laptop and do the first sort of hour of work in bed with my morning coffee, and that includes just sort of my emails, news, just looking at sort of what's happened in the market over the day. So there's sort of a process for that, and then I might head in after that to one kind of research or another. So either speaking to someone or it's updating something in my financial models or just reviewing something. Maybe I dedicate a day to a specific industry or to updating or just reading some reports to learn more about new technology or whatever. And then from whatever is in my research plan, effectively, what do I need to know that I don't know, based as I can evaluate, then that's something I need to learn more about. Then I'll try to learn more about that. Then I have four employees that help me. So I also sort of got to spend a bit of time on giving them feedback and giving them new assignments and reviewing the work they've done. And then that sort of, I send something out, it comes back after some time, and then I can incorporate that into my flow. And then
Yeah. Are you based in London? I'm sorry. Go ahead.
yeah.
Cut you off.
So yeah, I live in London.
London. All right. So Naval Ravikant. I'm not sure if you know who he is. He's an Indian American investor. This guy is very into philosophy, and he talks about you know he tries to define efficient work, and he talks about he says that 40-hour work weeks are really it's a relic of the industrial age, and now knowledge workers, they function like athletes. You train, sprint, and then you rest, and then reassess what you've done, and then repeat. the amount of hours you put into work every day, do they matter, or is there a smart way of working? Is it about how much you work, or is it about how smart you work?
It's
With all the
definitely
numbers.
I mean, the most important is how smart I work, because there certainly can be times where I took a break and then get an idea, and then that little idea is like, wait, I could just do it this way. That saves three weeks of work effectively. And there are other times because I learned this, and then that enables me to, in a short period of time, put it all together and be like, so this then. And of course, if I some analysis that could be done again and again and again and again, after some time there can be ways to automate it or to do it in a smarter way. So then working smartly to get that done once and for all, and then sort of it's never once and for all, because then you need to change over time. But those skills something. But I do work a lot. I usually work from I wake up till I go to bed on Monday to Thursday. Then I do a half day on Friday, and I never have a day I don't work. I do the same routine on Saturdays and Sundays in the morning to just go through what's happened in the markets and reply to any comments and questions that I've gotten from people on eToro. And then if there are other things, even during the day, I might, if I'm at a bar, I see several people wearing the same fashion item or drinking the same drink. I'm like, let me just look at the profits and revenues of that company, and then I'm just looking at this like, maybe I'll just put that on my research list when I come back. That looks interesting. So in that way, it never sort of leaves me, but it's not a normal job. It's not for everybody to do it to this extent. This is because I've decided to do it the entrepreneurship way. So I have several friends in London that have made their money by building a company and selling it, and I know that in the years that they did that, they were working all the time as well. It was a absolute full-time commitment, and so that's how I'm trying to run my portfolio as well, to say that this is my plan A. There's no plan B, and there's nothing else that I need to do. Everything else can somehow work out. I'm just going to do this thing, and then then I think, I don't know if maybe I could still be number one if I didn't do it that way or something, but I'm not gonna sort of take that chance. I just want to know that when I look back, so like I did everything that I could, and then then I can't be like wondering, well, oh, what would have happened if I had done everything that I could have done? No, I did that, and then it has worked out. So think don't want to mess with that recipe now.
Yeah, of course, and it probably doesn't feel like work to you, right? Like, because you enjoy it so much, or does
I would say
it
there are
feel?
two parts of it. I'm not naturally interested in all the sort of promotional work or in answering lots of questions, or like there's lots of sort of stuff around the work. There's also administrative work, like you have to fill out some forms or read the update to something, and there's lots of that sort of you have it in many
People working
jobs.
for you.
Yeah, I have to do lots of that stuff as well. So that I don't enjoy. But there's other stuff, and also my research plan doesn't always align with my curiosity. Like if I could just follow my curiosity, the research would be a lot more fun. Because the other stuff, I'm like, oh, I really want that, about that detail now, and I want to dive down into that. But then I sort of got to get back to the research plan again. It's like that is really nice, and I am curious about it. And maybe in a few years I'll have time to get to learn that bit. But it's really more important that I learn about this now and get up to date on this thing. Then I sort of have to, which then makes it less fun. But that's I do the thing that I do like about it is the learning, that because I'm my best friend Jacob, I don't remember, Jacob Hasselbach, back from the university. He's a associate professor now at the business school, and he gets to spend all time researching as well. Deep diving in, learning, researching. Of course, he's got to write some papers, and I got to click the buy button on some stocks once in a while. But fundamentally, we have the blessing that we are allowed to just spend all our time on learning. And so I feel like I've spent all my life on just doing research, and at least if nothing else, it certainly helped me to look into some things, and then so.
And you end up learning about different fields, like even fields you wouldn't be naturally interested in. You have
Definitely.
to know that, right?
Well, certainly I was never the least interested in like a pharma or biotech or biology or anything like that, but that was forced on me by the arrival of COVID. So I immediately had some late evenings there where I read 5 books on microbiology and 2 on genetics at the outset of COVID, just to say okay, I can't be below average in this. I'm obviously not going to be a scientist in it, but I gotta be able to sort of understand whether I need to trust something or not trust something, and sort of every bit there extra gives you a bit better chance of making the right call in some areas. And there are some areas, of course, where if something's brand new, it's easier to get to the highest level of knowledge because other people don't have already 30 years of experience in something. But there are other areas where where that experience is impossible to catch up to. But then sort of I think if you speak with the right people and you ask the right questions and you research and things, and you can sort of get from 0 to 80% in a field quite quickly, and then you can probably never get to the 100%, but you can find out at least what is the value of adding this. And there are other times where I've made effectively, whenever I make an investment in something, it has to be something I'm an expert in myself, or I know someone who is. So there is a bias in my portfolio to industries I've worked in as a management consultant, because I was forced as a consultant to learn about those industries. But there have been others when I invested in genetic stocks very early on, and that was just because I had one friend who was doing a PhD in genetics at Oxford University, and then I just could ask him all my questions, like, so what about that, so what about this, and he could be like, yeah, but what you're not understanding here is this, and what you're missing here is that, and then sort of that certainly helped me get to some good decisions that I would not have been able to, and certainly I could have never just picked up and read the academic articles or whatever to get anywhere.
That's a very interesting standpoint. I think teachers at university, yes, they do a lot of research, but then they don't really apply it to the real world. I mean, I'm not judging, but it's just different. Whereas you do a lot of research, but then you apply it to the real world, invest money, and then generate money. So which is good.
I mean, we all get paid, and it all may or may not have an effect. I mean, when my investment on behalf of all of the investors in Tesla at the right time, at their worst time, I will always have this little hope that maybe that was just what triggered the banks to be a bit more lenient on the bonds, to have them, hold on, so that this could have happened. But you can't. I can't really know whether probably I can conclude that was not what happened. So it's but I mean, it does matter where you deploy your capital to. When you move, when a large group of investors do move money from one business to another, that company can effectively issue more shares at that higher price and use that to build a new factory or to hire more employees, to kick off new projects. So that way you do really move the world when you move around capital. But then again, ideas move around too. If someone is able to very categorically, as university professor, either showcase something and really drive the point home with good language, the relevant numbers and so forth, and that idea spreads, then that's a very, very powerful line of work in terms of influence as well. And of course, you can have lots of people that are also just if you're just buying and selling some different stocks and you're making some money and someone else is losing that money, that bit of it didn't really matter.
I would like actually to go briefly to this. I think it's a priceless point of view. When you talk about becoming an expert in something, you can go from 0 to 80% very quickly. Now I have two questions on this. What is quick? And then the second question would be, where do we find the right knowledge? Is it in books, online, both? And how can we tie this up to the stock market if I want to educate myself on the stock market before investing?
I mean,
without revealing any of your secrets.
Yeah, and I mean, there you can use YouTube audiobooks, read reports, speak with people, many different sort of in different fields, and for different people there'll be different kind of contents that work well. But it could also just be that in that field they haven't done this one well, they've done this one well instead. So you're sort of reliant on how good the quality of educative material is to begin with. But the absolute key bit to a very, very quick learning in an area is to separate vocabulary from knowledge. Because you can quite often have a field where you have a lot of extra unnecessary words for the same thing, or you have like if you have someone who studies biology, they might call it like a pod of whales or a murder of crows, or where all of these words could really just be replaced by group. And but you can spend a lot of time learning all these, and of course then that might help you to communicate with others faster in the industry. It does have some advantage. Vocabulary is necessary to a certain extent, but there's a lot of times where you realize they are actually just sort of these three factors, and they are at different levels, and based off of that you have 100 different units, but you don't need to sort of name all of those units. It's different when you got to like prove your knowledge in exams and stuff, and then you often do need to memorize all of this vocabulary. But if you just focus on what is the core underlying knowledge underneath it, and get in fact, that was a lot of my work as a management consultant, is to go into a department, you talk to the head of R&D and whatnot, and they give you everything in jargon, with lots of abbreviations, everything, and you turn that into management speak. So go like, right, so what that really is just this, and what that really is just this, and these 5 things are more or less the same, but we'll just say this one is the light one and this is the heavy one, or whatever it is. Then sort of with that thing you can and if you want to learn really quickly somewhere, you can be lucky that someone already did that, so they already sort of synthesized and took out a lot of the unnecessary vocabulary to just leave you with the core bits that you need. And then, I mean, you can't boil the ocean is another famous saying, right? You can't possibly pick up everything, so you also got to be like a sort of specific on what exactly it is you need to make your decision here. Because for me, it's always going to come down to investment decisions. So I just need to know that this is less than 10 million, then I don't care about it. So it's like, then I see, it's going to be somewhere between 2 and 6. I could like research that more, but I already know, fine, that's way less than what's relevant here. Or there is some risk, and I'm like, oh yeah, that's a risk. Let me just calculate what it roughly is. And if I'm ballpark right on that, I'm good to go. Then I know I don't need to delve more into that. But there can be other times where it is like, I really, really need to know whether this is 1% or 1.1%, because that makes all the difference here. And then, then you have a bigger research task here. Or I need to know whether they're going to use this product or not. And
So you're basically saying that we need to get the fundamentals right, and then with experience, we improve our performance.
Say that again.
Like basically, if I were to conclude what you were saying, is that first, there's a lot of jargon, there's too much information going on. You just need to get the fundamentals right, so understand how things work on a fundamental level, and then once you do that with experience, you will improve your performance.
I mean, the thing is, you can pick an area and you can learn it very sort of at different speeds. But if you want to, like, if you come into a firm as a consultant, for instance, and you want to be able to be perceived as someone who's been there for a long time, then you need to work a lot on the vocabulary as well. So you might just memorize all of it, memorize all the abbreviations in one long go, memorize everybody's names, so forth. Now you'll seem like an insider, but you haven't actually you aren't actually able to contribute to the field. So very often where I can say, oh, I know that this complex word consists of these 5 things, and this one consists of these 3, and so forth. But just by knowing these words, you aren't able to contribute anything here. But there are other like levels of a lot less knowledge than, but you are actually able to suddenly say like, oh, this is this. So what about this? And people go, oh yeah, I didn't think about that. That was a good idea. So sort of, and that, so to get to that level quicker, there's a lot of stuff you can sort of you can sort of skip along the way. But there's also when people are trying to, when you read up a report, for instance, from a large organization, or someone's trying to be a teacher, whatever, there are quite often then people aren't really trying to teach you. They're trying to sound smart by using some unnecessarily complex words, or showcasing that they have this wider vocabulary than is necessary. So they aren't trying to make it as easy to understand as possible. Maybe they're even trying to make their own field sound more complex than it really is. And so people are communicating for lots of other reasons than to teach you. And so sort of for that, I sometimes hire tutors online, so PhDs that are in a field, just so I can have just have a one-on-one, just asking questions in their field. And then sort of if you get a good one, they'll they'll I suppose different people have different styles of communicating whatnot, but some are so caught up in their my field is complex and I gotta give you all the complexity, and others they are more able to sort of cut into the stuff that you're actually looking for, and sort of something like I spot a lot of mistakes and stuff whenever I see educative material, and I have a lot of sort of views on that, and it's I don't know if yeah, maybe I'll try to synthesize my own thinking on this at some point, in terms of what is really take to make something that is that gives that if actually, one area where people have thought about a lot is actually people that write board game rules. So in you see, if you look at rule books for board games a long time ago, they were just like, they just said, we assume you're going to need to know everything, so we just start detail after detail after detail in logical order. But then you realize, we can convey the same amount of knowledge to you if we start with giving you an overview and then filling in here, and we don't need to have 8 different categories. If we merge them into 3, it's easier to sort of remember that there's only, and then in that style you end up having the same amount of complex knowledge and the same amount of sort of actual content, but with a lot less vocabulary. With we don't need these 5 terms, we can, when 3 can do it, and stuff like that. And a lot of knowledge in the world need to be synthesized like that. And one of like the worst examples is, for instance, physics, where when you see many annual report from energy companies, they'll measure the different types of energy they produce in different measurements. It'll be like, oh, we produce this many kilowatt hours of this and this many gigawatt hours of that, and then you'll say kilowatts later, but not kilowatt hours. And then it's like, they make it, but if it's a good report, they'll just measure everything in the same unit, because the units are all they just have the same fixed rate to one another. So then if you do it that way, suddenly it's very easy, because you could be like, okay, so you have 99% fossil fuel production actually, and only 1%. But it's more difficult to see when you're using different sort of units. And well, that's an example of someone who's trying to communicate something and seem like they're communicating something, but they really actually don't want you to understand what's being communicated.
Yeah, exactly. And actually, that's for Christmas, I bought my kids a board game. Speaking of board games, and to teach them how to code. And obviously, there's all these different rules, but inside the box, you have just brief, like 5 lines of how to start the game. So it's just an overview, explaining in easy with an easy vocabulary how to play this game to start with. And once you start and you start playing, and then it gets much easier, because yes, of course, all the other details can always go to the book, to the guide, and look up the details. But it's very important to cut to the chase, and just have an overview on these things. Speaking of which, is there any books you recommend to that are good for new investors to read before trying to buy stocks, or reports, or websites, or YouTube channels, or podcasts?
I mean, I only know sort of the old stuff, because it's I don't read beginners books for investments anymore, so I can't really. I'm sure there are some
At
better
some
ones
point, you
now.
will.
There is, I mean, the old classic is called The Intelligent Investor by Benjamin Graham. Thing is like 100 years old at least, or I don't remember how old it is, but it's certainly not a brand new one. And I mean, I think a lot of what that says probably still holds true, and there's probably some newer version of that would be the right one for most people. I think if people can somehow manage to not get sucked into what's called technical analysis, then they've done well. There's if you focus on, if you sort of set in mind that you're focused on long-term investments and you Google around that theme, you'll probably find a lot better knowledge than if you're Googling for short-term returns. And I think if you go to there's a YouTube channel as well. It's called something like I don't remember the name. It's something with basic and the word invest, I think. That has some, but it's not very high quality content or whatnot, but it does cover the right areas, and it is sort of like correct when there's a lot of stuff out there that's directly wrong. And people say that you can find all the knowledge in the world online. It's really true. The problem is that it's hidden among so much junk knowledge as well. So a lot of people that yes, you find the right YouTube video that teaches you exactly what you've probably watched 9 that made you dumber on the way there, and so the net outcome isn't necessarily that good.
Yeah, so the best way to do it is just take the leap and start investing, like after educating yourself a little bit.
I mean, eToro has some educational material as well on eToro.com, but I haven't gone through it, so I can't like vouch for the quality of it. I mean, I do some videos as well where I explain my thoughts on things, and hopefully people have learned a little
Yeah.
bit from
That's
that.
what we think. What's your YouTube channel?
So everything for me is just Jeppe Kirk Bonde. So my full name without the spaces. It's also eToro. Well, yeah.
Well, my actually last couple of questions. The first one would be linked to parenting. As you know, I have 2 kids. You come from a background of parents who were uh, in more political than investment than oriented, investment oriented. But they must have installed in you something that led to your curiosity, because it looks like in order for you to become a successful investor across many fields, you need to be curious, or about learning in general.
I mean, I
Was
like
there one thing that
Warren Buffett, the greatest investor of all time. His dad was a senator in the U.S. So when I learned that, I was like,
okay,
okay, so that's a good coming from the and effectively when I did management consulting and banking in London, I was shocked very often how little people understood of politics and like how elections actually work, and sort of how what happens in an election is different from what happens in actual policy formulation afterwards, and what actually gets done in terms of regulation. So that sort of there's certainly also just sort of the most people have this idea that politics is something that happens out there. That doesn't seem to them as something that you can change like that. To me, regulation always seems to that stuff that people like my dad have written, and and then you can write it differently, and then it goes through a process, and then it's changed. It seems like it's like it's not like a Google Docs you can just go in and edit, but it's always seemed like something that if you talk to the right person about the right things, then it can be changed. It takes a few years and whatnot, but it's not something that's like but certainly a lot of people they take it as that's set in stone. And I think in the old days there was probably a lot of, if you were an expert in one field like politics or law or investments or technology or physics or whatever, then there was a lot of things to be gained. There probably still is. Then there's been in past many years a lot of people that have a lot of success by knowing 2 fields really well. And maybe now we've entered the area where the best things come from knowing like 3 or 4 fields medium well, and then you sort of find something in a where all those things intersect that people didn't think of.
Yeah, exactly. So yeah, that's also a very good tip. As a parent, you should think about, okay, teaching your kids that nothing is set in stone. You don't have to be an expert on one thing. You can be you just follow your curiosity, and you can be an expert and or know a lot about several fields at the same time, right? That might lead to a successful life.
Yeah,
Hopefully.
I think so.
Well, before we say bye, is there one piece of advice that you could give to the audience? If there was one, what would that be in terms of investment?
It is that for most people, it's worth evaluating if you have cash that can be set aside for investments for the long term, and if so, then at least consider investing in the stock market. And if investing in the stock market, invest, don't trade. Think long term, not short term. Diversify. I think that's the sort of core thing I think people should at
And
least
there's
spend.
no minimum amount. There's no minimum amount of money that that you need to start with. I remember on one of your videos you said we start with 300.
Yeah, it depends on the country. So I saw someone, I think one person was saying that he thought it was unfair that it was only $10 minimum in one country, but in his country, Colombia, it was $200. So I think in some places it's $50. So there are different minimum amounts, but it's not like the old days where you needed, the only way you could invest was to get an investment account with a, with a high fixed annual fee and stuff like that. So it was really only for relatively wealthy people. It's certainly, I mean, that is part of the rise of the retail investor. It's just that the costs have come down this much, and the ease of access via an app and a website, that's made it. And I mean, investments aside, if you take investments, insurance, pension, property, and all this, I think a lot of people should definitely set aside at least one day per year to review their finances, and whichever area then they want to spend that day on optimizing, whether that's changing from one provider to another, or changing it's you could probably end up spending more than that, but for almost all people it's definitely worth to spend at least to dedicate 1 day per year to just looking at your finances.
That's fascinating. Thank you so much, Jeppe, for being with us.
You're very welcome.
And I look
Thanks
forward
for
to
having me on.
our next episode.
Yes. All right. Thank you.
Thank you. Thank you so much. Bye.